like 1929 bubble, okay, or the 2000 bubble. And sometimes they borrow money to bet on it, and they lose sight that the price of it matters. So anybody who's in the business of making AI can't be precise. But now, if you raise that, you're a billionaire. In order to spend it, you have to sell some of that stock to get money. There's almost nothing that's easier to produce. It's more like they're crap shooting, okay? And then that's a sign of a bubble. So the important thing always is to diversify.
In 2008, while the S&P 500 fell 37%, one fund went up 9.4%. The man who ran it built Bridgewater from a 2-bedroom apartment into the largest hedge fund on Earth, and by his own count, made his clients more money than any fund manager alive. Ask him what that number was, and he almost shrugs.
It was something like 53 billion. We produced about a 12% return with never any significant losses, and it was uncorrelated with other investments.
He called the last one. Now he's looking at this one, the AI boom, and he will not say the word crash. He'd rather show you the machine underneath it.
I don't want to jump to conclusions as much as I want to explain reasonings that lead up to conclusions. I'm at a stage in my life that I want to help people understand cause-effect relationships. What they call a bubble is when the price goes up a lot and companies do very well, and then it collapses. And that has implications for the economy, that has implications for the markets. Like 1929 bubble, okay, or the 2000 bubble, okay, which was the dot-com bubble.
Two bubbles, 80 years apart, in the same shape both times. But knowing what a bubble looks like from the outside isn't the useful part. The useful part is what it does to the money you think you already have.
All the stuff that we have, that's wonderful new technology. People get into that technology. They say, that's miraculous. I can bet on that. I'm sure it's going to be successful. And then they bet on it. And sometimes they borrow money to bet on it, and they lose sight that the price of it matters. So it goes up, and it's everybody's thing, you know? It's like right now we're very excited about AI, and we should be very excited because it's going to be revolutionary changes. And it bet at the same time, so I want to buy some of that. And everybody wants to invest in some of that. And what they do is they don't pay attention to the price, and there's a certain mechanics. People will borrow money. Wealth is not the same as money. So you see a lot of people getting wealthy, but you can't spend the wealth. You have to sell the wealth to get money, because you can only spend money, right? So what happens is when they need money, for one reason or another, taxes change or interest rates go up, and so they have to pay their debt service and so on. There is a pricking of the bubble so that what happens is it falls, okay? And when that happens, people lose money. And as they start to lose money, the process works in reverse, because when they made a lot of money, they have a lot of collateral, right? They can go borrow money because they're worth a lot, and that compounds on its way up. And then when it comes down the other way, it works the other way. Okay, now you got to pay your debt, and so on. Then you have to start to sell assets, and then there's less demand for things, right? So there's less demands, because if you're losing money because you put some money in the stock market and the company and so on, you're going to spend less. And as you spend less, then somebody else's income goes down, right?
So the wealth was never money. It was a number attached to something nobody had sold yet. And when the selling starts, the number goes first. Then the spending. Then somebody else's wages. Dalio's point is that this isn't the system failing. The bursting is the system working exactly as it was built.
And it happens because it must happen. I mean, meaning in these tremendous changes, there's very little that's known. So anybody who's in the business of making AI can't be precise. They don't know exactly how much money is going to come in, right? So there's either one of two things. You either don't invest enough and then the competition runs away, or you invest a huge amount. and you can't be precise, okay? And so when that dynamic happens, it's a problem. So yes, you said it very well. So I'm going to repeat one other thing to emphasize. What's quite common now is you can issue stock for, let's say you raise $50 million and you value the company at $1 billion. Only $50 million was actually spent on that company. But now if you raise that, you're a billionaire. Okay? Because the accounting value of that, what do you own? You own stock that is valued at $1 billion. Nobody paid $1 billion or whatever it is, right? And now you own that stock. But that stock you can't spend because you can't spend wealth. In order to spend it, you have to sell some of that stock to get money.
Yeah.
Right? And quite often there's an interest rate rise because that, let's say there's a fever and there's an inflation, then the central bank wants to try to put the brakes on that a bit. Okay, what does that mean? It means people who have debt, in a sense, have to come up with more money. Because when you own the debt, you have to come up with money to pay the debt.
So
and that dynamic
spiral
works. Between us, we've said it clearly.
Yeah.
I think we understand the dynamic. So they have to exist.
$50 million in. $1 billion valuation out. A brand new billionaire who cannot spend a cent of it without selling the thing that makes him one. Multiply that across a whole sector, and you get a market where almost nobody can actually cash out at the price on the screen. So what makes them try?
There are bubbles, and then the things that prick the bubbles, okay? The things that prick the bubbles, typically, in the beginning, are something that means that I have to sell some wealth to get money. And that's usually a rise in interest rates. It could be something like wealth taxes. Something that means I'm very wealthy, but typically the tightness of money, because during that spot, there's inflation pressures and central banks decide that they want to tighten monetary policy and so on. It becomes that the amount of money that I can get by owning that debt at the higher interest rates is greater than the amount of money I could get on my equity investments. That's part of it. Also, what you see is a lot more production of stock. And what I mean by that, issuance of stock. Think of the supply and the demand. There's demand, right? And we've been talking about the demand that makes stocks go up, how we create this wealth. But there's also supply. So you can issue stock. It's very easy. There's almost nothing that's easier to produce than stock.
So if I own a company, I can just print more equity.
Yes, today you could probably go out and say, I'm going to make a company and I'm going to take it public. And you go to your audience and your crowd and you can say, I'm going to make stock. Okay. So it becomes when there's a market that wants stock, there's a production of stock.
And
that supply of stock together with the other that I'm mentioning, the need for getting money and so on, causes the bubble to pop.
Rates rise, debt gets expensive. The people holding the paper suddenly need real money, and the only way to get it is to sell. That's the mechanism. The harder question is whether it has already started.
The classic signs that we're in. And the bubble, I should emphasize, it's not a you're in a bubble or you're not in a bubble. It's a degree thing. Okay? There is also that it's in weak hands. I can look at now who is in these companies, right? And is it in strong hands or weak hands? Classic strong hands is that when weak investors, not knowledgeable investors, then put a lot of money into it, particularly if that's in a leveraged way.
With debt.
With debt. Or they can buy a leveraged version of that. Like there are ETFs now that are leveraged versions of the stock market and so on. And so they get into that. It's more like they're crap shooting. Okay. And then that's a sign of a bubble. So I've listed a few of those signs. Those are the major signs of those bubbles. And so that when it goes down, then you get the fear, then you get the need to raise cash, and that dynamic works its way out in the form of then the reverse happening.
There's a tell that never shows up in the data. During this same conversation, the host, Stephen Bartlett, described a phone call he'd taken. Not from an analyst, from a man running an AI company.
If we are in an AI bubble and it is going to burst, I had a friend of mine contact me and he said, Stephen, I think we're in an AI bubble, and he's running an AI company. So he said to me, I'm going to raise lots of money now so that when the markets come down and investors are fearful, they don't want to invest in companies, people stop spending as much, they start thinking about their subscriptions and start canceling subscriptions, we're going to be good and we're going to be able to buy up some of our competitors who are going to be struggling. So he's just raised hundreds and hundreds of millions of dollars for his AI company.
And what that does, and just following up through on what we were saying a minute ago, is that increases the supply of AI stock.
Okay, yeah, because he sold stock.
Because he's
at a
going to
high
sell
valuation.
more.
Yeah.
Right? And so as he and others do that more, this greater supply of stock comes in. And so he wants to get ahead of it in that dynamic. And then, that contributes to the bubble.
So the people closest to it are already positioned for it to break. Which leaves the rest of us with the only question that actually matters.
I would also say something. The future is very unknown. And people should not be timing. Sophisticated investors have a real challenge even in timing a bubble. So the important thing always is to diversify.
Dalio isn't giving you a date. He's telling you the machine has a shape, that it has run before, and that the people building it are quietly getting ready. You don't need to time it. You need to not be the last one holding the number on the screen.